The opinions expressed on this program are those of the program hosts and guests and not necessarily those of this station, management, staff, or sponsors. WPSL does not endorse products that may be mentioned. Any reproduction or retransmission of this broadcast is strictly prohibited without written consent of WPSL.
It's time for Sun Palm Financial, the radio show, the internet show, the worldwide show with Mr. David Cummings.
Hey, welcome to the Sun Palm Financial broadcast, everybody, where we talk all things money. I'm your host, D. Thomas Cummings. My friends and my clients call me Dave, and we're coming to you here live from the Treasure Coast, and we're here in Florida, talking to a worldwide audience on Alexa, Google Home, and the TuneIn app. So welcome. We're glad to have you here listening. So before we get started, we always like to let people know we may be making some financial suggestions in the broadcast, so a quick disclaimer. The information and opinions contained in the broadcast have been obtained from sources believed to be reliable, and they are given for informational purposes only. The information is not intended to be used as the sole basis for financial decisions or a solicitation to sell.
Thank you, Dave Ramsey.
Yeah.
Oh, wait a minute. That was last week.
Yeah. So last week we had a great chat. It was we were talking about these quote unquote financial gurus, and we did kind of a deep dive of each one of them. Including our favorite, which he just mentioned. And at the end of the day, really, we've demystified them. They're really not financial gurus.
They did have something in common, though.
Yeah, what was it?
Bankruptcies.
A lot of them. A lot of them had bankruptcies, and most of them do not make their money by being smart investor, financial gurus, but they make their money by selling what? Selling the dream.
That's it.
Yeah, so we did take a little bit of time. We talked about those folks, and we also looked at, what are some things that you can do to find the right person to be your financial advisor. Of course, we talked about, make sure they've got a license. Most of the people we mentioned didn't even have a license, so I don't know how the regulators are not like coming down on them for giving financial advice. Probably they're in a state where you may not require one. Unless they're giving specific information to clients, which some of them do. So don't know how they're getting away with it. But we also talked about, you're looking for insurance, you're looking for education, you're looking for personal success, which was a big one. It's like if you're not going to go to somebody and approach them and say, hey, you're not a personal success in finance and in business or, in investing. Why am I going to get information from you about my own assets if you've not been personally successful, right? So we talked about all these things. Now today, the topic is going to be, it's what I like to call the $1 million question. If you had $1 million, what would you do with it? Would you even know what to do with it? And just, I guess it was last week, there's a guy or a lady, I think it's a gentleman, out in Oregon somewhere, just became $1.2 billion richer with this lottery. That just went up to that sum. Now, I think it comes to around 667, somewhere around that range if you took the cash option. What is this guy going to do with the money? What would you do if you came into a lot of money? So today's topic is essentially, how do you make money? What are some of the basic investing principles that exist? We spent last week talking about the gurus, how they really, in a lot of ways, the information they provide is either regurgitated good information from other people who actually are successful in financial worlds, or they give a bunch of hogwash, which should be thrown into the trash can as quickly as possible. But you're not going to know the difference if you haven't increased your own financial IQ, okay? So if you don't know any better yourself, then you're not going to be able to identify. So Million-dollar question. I'll leave this open to the audience here. 772-340-1590. What would you do if you had $1 million? And I am also live today on the Facebook app. And so we're going to be getting a couple of those folks that will be reaching out to us as well. So when those come in, I'll respond to them. So now, what would you do with $1 million? So the first thing that I ask people when I ask that helps me to kind of gauge their financial IQ. Because the truth is, if you look at our educational system, the single greatest failure that we have in our educational system, in my opinion, we don't talk about money. We don't teach our kids about money. And it's a terrible thing because, money is what makes the world go round. Money is what drives countries and businesses and communities. And in our personal life, you have to have it. It's an important tool for life. And in fact, the person who understands how to use money is the person who's going to have the ability to pursue their dreams and all the things they really want to do in life.
Now, are you talking before or after taxes?
That's for sure. So,
Big difference.
yeah, he's a good question. Is the $1 million before or after taxes, right? Well, we're just going to say before taxes.
Okay,
How about
okay.
that? All right. But if you want to chime in, 772-340-1590. We're also on Facebook Live. So what would you do with $1 million? Now, money's not taught in schools. And in fact, even when they have business classes, and I'm talking about high school, K through 12, when you get into college, you do learn a little bit about money if you focus on business or certain topics like that, finance or whatever. Then you might learn a little bit about money. But even then, you're really taught more business concepts, and you don't really learn anything beyond your basic revenue generation for a company. You at least kind of start to understand some things. So the first thing you have to understand when you're talking about money, you got to know the difference between an asset and a liability. Okay? Now, this seems like a pretty simple thing. For instance, if you own a house and you live in the house, is it an asset or is it a liability? That's a good question, right? Well, some people would say, oh, it's an asset. Not really, because the true definition of an asset is something that pays you money, right? It's something that is bringing in money. Your house is not bringing in money. It's actually a liability because it's taking money away from you. Now, maybe when you look at it in a situation of value over the 30 years that you're paying on the mortgage, it's gaining value. So in that respect, it's an asset, but it is not an asset that can be materialized until you sell it.
That's interesting. That's very interesting.
Right? So that's the difference, right? A car, asset or a liability.
Definite liability.
Right. So the second you drive it off the lot, if it's new, it's just lost value.
You just lost 10 grand.
Yeah, boom, right off the bat. So typically, if you're going to buy a car, buy a pre-owned, low mileage, almost new car, right? That's what you want to do. Now, this is kind of funny. I've tried to convince the wife, she's not here today, she's meeting with clients, but I tried to convince her that buying a Ferrari is in fact is an asset, not a liability. And she didn't buy it. I don't know why, because I went and I showed her that my dream Ferrari, the Ferrari Dino, has gone up in value. So I think they were like $40,000 at production back then. It's a classic Ferrari.
Those things are cheap.
Yeah,
Get a Lamborghini.
Classic Ferrari. So then now they're worth 380 to $500,000, I think. So anyway, but jokes aside, if you're talking about cars, it's definitely a liability, but there are some classic vehicles or some really sought after vehicles that if they're kept in the garage, they're made. Now you got an asset.
Go into Jay Leno's garage.
Go into
and
Jay
see
Leno's
those.
garage. Classic example.
Yep.
So you have to understand the difference between what is an asset and a liability. All right. Now, when we're talking about revenue generation, this is one thing that students in particular have to understand. From your youth, you are bombarded with images of things that you must have and can't afford. I would say. And you say, well, why is this the case, right? So, when they market to kids, it's that brand item, those specific tennis shoes or those specific brand clothing, these kinds of things. You're bombarded with these things from your youth. And as you get older, it's funny, parents say, oh, well, don't cave to peer pressure. Well, how about you live that as an example, mom and dad? How about the commercial for Mercedes-Benz? You deserve it, right? Do you really deserve it? Maybe, but you don't really deserve it unless you've earned enough to pay for it, right? Because their version of you deserved it is you deserve it to be in debt for the next, however long, and some astronomical amount of money per month, right? So this is a debt-driven society, and a few shows back, we talked about the Federal Reserve, we talked about the U.S. banking system and how money is created, and money is created out of debt, right? Go back and check that one out on WPSL TV, Sun Palm Financial. If you go do that YouTube search, and you can check that one out, because if you understand that we're in a debt-driven society and that's how money is created, then you start to understand, why everything is, priced, at these ridiculous numbers, and they're always advertising you have to have this to be a somebody, right? So once you understand that, you kind of can steer around that. Now, education alone has become a massive debt obligation, and in some cases, there's no real return. I'm just going to say it like it is. If you are getting a degree in underwater basket weaving, that's an exaggeration, but there are many degrees out there.
That is a course at ASU.
Yeah,
Oh.
there's many degrees that you can graduate with that degree, but there's the amount of debt you've acquired in some cases just to get that degree, it'll never pay for itself, right? So really, you're not going to walk right into a job in your field and that most times. And a lot of students are going the vocational route. So they may be going into a specific area. Let's say I'll give you a couple examples. There are people who are learning electrical vocation. By the time they go through that and they get their journeyman's license and then they get their final electrician's license, good living there, not bad, right? Electricians in Florida are highly sought after for construction projects and for maintenance and these kinds of things. And even large companies, here we have Florida Power and Light, they have needs for electrical technicians and so on. So a vocation may be the way to go. AC tech, air conditioning technicians. In Florida, if you don't have air conditioning, you're going to die, especially in the summer. So having that vocational technical license often goes further than a college degree in your traditional liberal arts. So if you're going to go into and invest your money and your time into a 4-year degree, let it be something that is focused on really an area that is in high need and will be in high demand for some time, and it's got a specialization to it. So medical field, right? Nursing is a big one, right? Medical school for doctors, having your license to be an MD opens some doors for you. A huge expense there, but it does pay for itself. Law school, if you go and you get your law degree, that opens the doors to many different fields. You don't just have to be a prosecutor or defense attorney or be like these people that sue all the insurance companies to make a living, ambulance chasers. There are many different areas and specializations in law. And even if you don't want to technically be a lawyer, once you have that degree, if you're a company owner or you're a senior executive, you can navigate your company through areas of legal concerns because you have that law degree. So good thing there. Engineer, if you're an engineer, mechanical, electrical, biochemical, rocket science style, that's also a great direction to go if you're looking at education. So just a few things. So we've gone from the spectrum of vocational licenses to some of your higher education type of deals. So, but at least you want to invest in something where there's going to be a need and where there's going to be time that you put in that gets reciprocated. AI is replacing so many jobs these days. We just heard about a fully autonomous restaurant, fast food restaurant, that's now run by robots. So the burger flippers, I mean, that's the people who
That's
make
the first job for a lot of high school
it
kids.
is, and a lot of those are going away. Like when I was a kid, you know, it was mowing the grass and delivering newspapers, whatever. They don't deliver newspapers anymore.
What's a newspaper?
Exactly. So you see what I'm saying? Now AI has replaced a bunch of tech jobs. There's 10,000 plus people out there that just got laid off recently in the tech fields because AI is replacing all those analytics type of jobs. So those people thought, hey, I'm ahead of the game. I'm in a tech job. And now they're finding out that's not the case. They've also talked about the trucking industry is being replaced by autonomous vehicles. So this is a major revolution that's happening. And I don't know if people really understand it. We've had various revolutions of the industries, and this is a big one. And, you know, we had the Industrial Revolution, for instance. That was a big change, right? And then we had the tech.com type of transition back 20 years ago. And now we are at AI and automation with robots and stuff, the Jetsons kind of thing. And so we have to be thinking ahead on these things. Now, they're even talking about so many jobs are being looked at for automation that they've been talking about what are all these people going to do for a living? And so they came up with this idea of what do they refer to it as? I forget, but it's basically where you just get a stipend every month from the government to live on. And you're not actually going to be working.
Wait a minute.
Yeah. Yeah, it's already happening in some states. California's trying it out, other places, and it's being talked about.
California is 78 billion in
Now-
debt.
And now you can see why. So thank you for that segue, because I'll tell you, if you're a business leader, business owner, a baron of industry, listen to what I'm about to tell you. If you're going to streamline your business and just automate everything, and you're going to put a bunch of people out of work, and then this is all going to shift to this, you know, automated income that people will get every month, this stipend, guess who's going to pay for that? You know, the big barons, the big business leaders, the big corporations are going to be taxed to pay for that. So wouldn't you rather just have people working for you? Right? Couldn't we just keep it human? You know, and on top of that, one of the big things that kind of irked me is back when they did this huge tax break for the corporations. I was in favor of it. I thought that in order to compete with international business, we needed to lower our tax bracket for corporations. It was at 33%. I think it's now at 21 something. But there should have been some sort of qualifier. In other words, you have to keep at least 90% of your workforce human, right? You have to, you know, take that windfall that you just got and give it back to your employees in a pay raise, these kinds of things, right? To where everyone benefits from it. And some corporations did that. Some used the money to expand and all of this. But others, they took all that money and guess what they did? They laid off half of their workforce and automated it, right? They didn't expand anything, right? So they just, you know, if you're Walmart, for instance, imagine the profit that you just gained when your taxes went from 33 to 35% down to the 20s per year. We're talking billions of dollars per year, right? And now you're checking yourself out at the grocery store at Walmart, right? And so, and the cost of everything hasn't gone down, it's gone up. So where's all this money going? Well, the big yachts and the crazy lifestyles that we're seeing is really, you know, there people talk about, hey, socialism is transferring, taken from the rich and given to the poor, and it's wrong. 100% agree. But there's a balance here, people. We also can't do it the other way in reverse, where we're taking from the working class and giving it to these folks in tax breaks and get nothing in return. So there has to be a healthy balance. So before we go on our commercial break, I did get a response, Facebook response, And when we asked, what would you do with $1 million? And this is exactly what I'm talking about. I don't want to say this person's first and last name because I'm going to make fun of them a little bit. I appreciate your
Oh, how about initials?
okay, SV. So Mr. SV wanted to get his $1 million, and he said he's going to buy a house, and I guess you instilled it in his mind, buy a Lamborghini. So, in other words, your money's gone after that. You have nothing left. You have a house to live in and a car to drive, but that's it. So, this is what I'm talking about. Money is not taught in school. So, when we come back, I'll see if we have any others on how you would spend that $1 million, what you would do with it. So when we come back from the break, we'll talk about what you should really do with it.
I donate it to the Christmas kids. Yeah, there you go.
Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to Sun Palm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, call right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
All right, welcome back to the Sun Palm Financial Broadcast. And we're talking today about basic understanding of money, right? How do you make money? How do you invest it? Just kind of the bare bones basics. And we're highlighting the fact that the stuff is just, money is not taught in schools. And we have students that graduate from high school, they have no idea how to write a check. We have adults who graduate from college, they don't know how to write a check. They don't know how to endorse a check or
What's a check?
yeah, exactly, right. How to open a bank account, how interest works, these kinds of things. Now, I could spend the next 10 years talking about those things, but I'm trying to keep it simple, right? We're just highlighting today just the basics. Next week, when we go to part 2, we're going to get a little more into the deep dive and the specifics. But I posed the question, and if you want to call in and give me your opinion as well, 772-340-1590. The question was, if I had $1 million, what would I do with it? 772-340-1590. And we also have it live on Facebook. And we got SV, I'm using the initials, said he would buy a house and a Lamborghini.
Yeah, my
Yeah.
kind of guy.
So let's talk about this. So first of all, I understand the part about buy a house. Okay, the average home is right around $425 to $450 nationwide, and a stat just came out here for Florida specifically. that in order to afford just the average home in the state of Florida, you would need to make $115,000 a year. So $115,000 a year to be able to afford the average home in Florida now.
To qualify for a one-bedroom apartment in Los Angeles, you have to make $100,000 a year.
There it is. And nationwide, it was actually almost 110.
Oh,
Now, there are certain states where there's still houses that are semi-affordable, but come on, man, $115,000. So SV, I get your point on buying the house. I'm going to make a suggestion, right? I'm going to show you right now how this should work. If I had $1 million, what would I do with it, right? Okay, so the smart answer most people would say is, oh, I would invest it. Well, that's the right answer. But the question is, what would you invest it in, right? How would you invest it? These are some pretty important questions. So I'll give just two examples. If somebody walks in the door and they say, Dave, I've just inherited $1 million. I don't know what to do with it. I'd like to buy a house and buy a Lamborghini. So here's what I would tell them to do. I'll give two examples, okay? First thing is, don't buy one house, buy three. So you're going to buy three houses at around $333,000. So you might have to look a little bit, find those deals, but they're still out there. You buy three houses for $333,000, and you rent them out, each one for $2K a month, right? Now you're talking about an income of $6,000 per month. And that comes to about $72,000 a year. Now, after your expenses and your taxes and all these other kinds of things, you're probably looking more at 45 to 50 a year. But think about what you've just done. You've just given yourself a job making $45 to $50,000 a year, and you own 3 properties, right? So what's beautiful about this is if you stay working, which is the smart move, you have $45,000 a year for rent, and let's say you only made $40,000 a year from your job. Now you've got $85,000 to $90,000 a year to qualify for your own home. And so you buy that house with your job and what you're making from your rent, right? And so now your job and these other people are paying your mortgage. And 30 years down the road, what do you have? You have 4 paid for houses. And guess how much those houses are going to be worth down the road? Okay.
Lot more than you paid for it.
Are you seeing what I'm saying?
Yeah,
So
actually,
right?
it makes perfect sense.
So you took your $1 million, you invested it in 3 properties, and then if you want to use that income or whatever to buy a fourth one, you've taken that money, and now those 3 houses, you're gaining value on them, and you're getting a job and income out of it, right? And think about it, your retirement plan is there too, right? So if you just stay working, making a reasonable amount of money, right? Let's just say, let's go to plan B. So this is option 2. Let's say you don't want to work ever again. You just want to sit on your backside and watch TV and go fishing every day. Okay, we can do that for you too. You got your $1 million, what would you do? You want truly passive income, like you don't want to spend any money. What would I do? I would probably not put it in stocks and bonds because there's a little volatility there. You'll never be able to inherit this money again. It's a once in a lifetime opportunity that's landed in your lap. Or maybe it's a situation where you're a retiree, you've earned $1 million in your 401k. You're like, okay, I'm ready to call it quits and never work again. I want truly passive income. I would drop it in an annuity, a MYGA, which is like a fixed rate annuity. And for $1 million, I've got one right now that we've got for folks sitting at around 5.3% roughly. So better than, equivalent or better than the average CD rate.
Much better.
Yep. And now you're pulling $53,500 a year. Not bad, especially if you don't have debts, right? And so that's two options. Because SV, if you went and you bought your house and you bought your Lamborghini, guess what? Now you have to still work, right? So here, at least you've got this 53,500, it pays the mortgage and you have money left over, whatever. And then down the road, when you get to retirement age, you've got your $1 million, right? And you've been paying on your house with this money, and a house, whatever. So you're set for retirement. If you're a retiree and you've already paid for your house, you've had this $1 million in a 401k, now you're set to retire. So it's just understanding the principle of how money works. If you don't understand how money works, you're going to blow it and it'll be gone in 2 seconds. And we see this a lot. We see people who, in particular, we've got some of these sports stars, they get a contract, right? They have all this money and wow, they live large, but guess what? It runs out. I mean, I'm not trying to put this fellow down. He's a champion and will always be, but Mike Tyson had this ridiculous house back in the day and it fell into disrepair and he ran out of money because guess what? The shelf life on being a fighter is, not where it should be.
Short.
Yeah. Now he's come back he's my age now and he's about to get in the ring again. A lot of people are saying it's his last paycheck or whatever, so he's really promoting the heck out of it. And maybe that's true. But had he had a Sun Palm financial advisor, we'd have had him living large for many years to come. Maybe not at the level that he thought he should be, but he would have lived large for, and this is the important point. Do you want to live really large for just a few years until it all runs out and you have nothing? Or do you want to just scale your lifestyle down just a notch, maybe notch and a half, and live that way for the rest of your life and then pass it on to your kids to live that way and then their kids to live that way? I'm going for option B. How about you?
The bankruptcy studies for NFL, NBA,
That's it.
and
Yep.
Major League Baseball players
Yep.
is usually by 7 years after
They're done.
they're done. After they're done,
Yep.
they file for bankruptcy.
Right. And then you can't go back and regain your youth.
No?
And this is the same thing to my working folks. You've spent however many years in the job working. You get towards the end of retirement. Don't be stupid with your money. Don't invest it in foolish things. Invest it in something that's safe, sound, and will be there for you because you cannot go back and rework your whole life again. So sunpalmfinancial.com, get on my calendar if you've got questions about this kind of stuff. Now, let's talk about some basic ideas here. We're going to take a break, and then when we come back, we're going to talk about, kind of the concepts of investing. So we're going to go to break now, and we come back, we'll pick up there.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at Sun Palm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, call right now to schedule your free consultation so that you can join the old club. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to Sun Palm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. Sun Palm Financial. Invest, grow, protect. sunpalmfinancial.com.
Welcome back to the Sun Palm Financial broadcast. We talk all things money, and today the topic is basic understanding of investments. We asked the $1 million question: if you had $1 million, what would you do with it?
All right, you got another response, I can tell.
I did. First of all, if you want to chime in at 772-340-1590, if you have any input, we're also live on Facebook. And SV, I'm using his initials, he had said he would buy a house and a Lamborghini, and I explained how then your money's gone and what do you do for a living, and I laid out two options for him. And then his response was, well, then when do I get the Lamborghini? All right. Okay. So SV, this one's for you. Here, I'm going to tell you how to do it.
He can live in his Lamborghini.
Right. All right. So SV, here's what you're going to do. You're going to take whatever you were going to spend on a Lamborghini. A brand new one is somewhere around the 300,000 range. So instead, you're going to go buy a house for 350, whatever, 333, I think is what we said if we split the money up through it. So you're going to take one of the houses that you buy and you're going to rent it for $2,000 a month, maybe a little more. And then you're going to go out and you're going to get an auto loan for your Lamborghini. And the renter is going to pay that. I think that comes to somewhere, auto loan for a Lamborghini. You're going to be paying, so you probably have to have two houses actually, but yeah.
Yes.
So if you want your Lamborghini, you go ahead and take whatever money you were going to put towards the Lamborghini and you're going to buy a house. You're going to have that person pay your auto loan. So if you can get an auto loan that stretches out over 8 to 10 years, which in some cases on the higher end you can, I'm just running the numbers off the top of my head, around $1,600 to $2,000 a month. So yeah, so basically you go out, you buy a house, you have someone pay rent, and then the rent, you will take that rent money and pay the payment on your Lamborghini. And so then at the end of your auto loan term, you own a Lamborghini outright and you own a house outright. Not a bad deal. So that's one way to do it. The other thing you can do, if the auto loan is too high and the interest rate, is you can go get a home equity line of credit. Actually, I wouldn't do a HELOC. They have a variable rate. So I would do a home equity loan, which is a fixed rate. Yeah. So
Oh, wait a minute. What's the difference?
home equity line of credit is a variable rate product in most cases. So if you get a home equity loan, it's fixed rate. If you get a home equity line of credit, it's variable. You want to have the loan option because it is stable. You know exactly how much per month you're paying. So you can take your $1 million, buy 3 houses for $333,000, and you would take one of those, get a home equity loan against it to buy your Lamborghini, and then your renter is paying for that, right? So then at the end of the term, you own the Lamborghini and you own the house and so on. So that's how you do it. Okay. There's other ways that we can go into it where you can really go crazy, but that's for my clients. I'm not going to give away everything. So it's something, I'm writing a book on this. It's called The Cake Method.
Are you?
Yeah, it's called The Cake Method, to have your cake and eat it too. Yeah, where you can, some income strategies, I've used them in my own life, they work, where you can absolutely have the stuff that you've always wanted and dreamed of, but at the same time, you want to be able to afford these things. So Cake Method, be coming out sooner or later. Now, when we're talking about income and we're talking about making money, there's a few things that we have to understand. We talked about the difference between an asset and a liability. Now, let's get to the next basic here. The next basic is, in order to grow or to make money, you have to find something of value. Now, I know this is a silly concept, seems common sense, but you have to find something of value, and then you have to buy it low and sell it high. Now, that seems like common sense, but you would be stunned how many people miss this. Buy low, sell high. I can't tell you how many times a client will come and they'll say, oh man, I see this stock, it's just been performing, it's way up there, I should get in on that action. Well, then guess what you're doing? You're buying high. And then when the company starts to decline, you're losing money, right? So you want to buy low and sell high, right? So we get this counterintuitive thing. So in order to find something of value and to buy it low, you have to have a bit of vision. You have to be able to know where things are going to go, whether it's going to turn up or turn down. And so how do you get this? Well, you do research. Good, reliable information about whatever sector you're looking at. If you're looking at real estate, the question I always used to ask is it coming up or is it going down? Now, there's so many great analytics out there available to people. You can go to any of these, real estate websites, and they actually will show you the trends with charts and the whole nine. That wasn't available to everybody back in the day. So you kind of had to really research it, but still I would research it. You want to look at what's being built around there, right? You want to look at the condition of the place. You want to look at the city's, investment plan for the next 5 to 10 years, these kinds of things. If it comes to other investments like stocks, bonds, mutual funds, you really want to look at several factors. First of all, people ask me all the time, hey, I could just invest this stuff myself and save the expense of the broker fees or whatever. First of all, a broker shouldn't be charging you more than 1%. If they're really like dynamite, maybe 1.5%, but they'd have to be crazy dynamite to do that. If they're charging more than that, fire your broker, come see me. So when we're talking about should we invest in stocks, bonds, mutual funds, or should I do it myself? Listen, I will just put it this way. If you don't know what a P&E ratio is, don't try to invest in yourself. If you don't know what a beta is, don't try to invest in yourself. If you don't know what an EPS is, don't try to invest in yourself because you don't even understand the basics, right? You don't even, EPS, earnings per share, beta is the number of volatility, your P&E ratio, price per earnings ratios, these kinds of things. If you don't even understand the basics, you're going to lose all your money. So don't do that. Now, you also don't want to go invest in a one-off type of stock, right? I've heard people say, hey, this one stock is really performing, I'm going to buy it. No, that's one stock. You never, ever, ever want to invest in one thing. You want to diversify your investments, right? Spread it out into a couple of different sectors. Now, there are some people, they have a mindset that, why don't I just take my money and stick it under the mattress? I'm afraid to put it in the banks, which I can understand. I'm afraid to put it in the stock market. I get that too. But let me just do some numbers for you. This is kind of a hard, cold reality.
I got a pretty smart mattress, though.
If you took that $100,000 and you put it under the mattress, inflation rate was at 3%. Now it's jumped back up again to what, 3.5, I think? It was at 9 last year, 9 something. 3.5%. We're just going to say the normalized inflation, which was 3%. If you took that $100,000, you stuck it under your mattress, in 30 years, guess what it's worth? 40 grand. $40,000.
Yeah, I believe that.
So if you're not investing your money into something that's at least performing in fives, sixes, you're not even making anything. In fact, let's talk about the fives and the sixes, because really that's kind of where it comes down to. If you look at the stock market, I was doing some research on this earlier. Let me see. There's some really good books that have been written on the subject, kind of looking at how things have performed or whatever. Jeremy Siegel wrote a book. It's called Stocks for the Long Run. I've read this book. It's got some great points in it, but this is something that really stood out to me. He did a research of 210 years worth of stock market performance. And the stock market diversified portfolio averaged at around 6.6%.
Nice.
Yeah, so 6.6%. Now, there are going to be highs and lows. You might be in the tens and higher, and you also might have crashes, which every 8 to 10 years we've got crashes. So 6.6% is pretty much what the performance is going to be over the past 210 years. So that's your example, right? So you're about 3.5% above inflation, right? So now I've got an annuity I mentioned a minute ago where there's no volatility with the market. It's just a fixed rate at around 5.35, maybe 5.5. The rates come out every so often. I would rather put it in there because then you don't have the volatility and you don't lose any principal.
That's what Carol and I would like.
Yeah,
I think.
so you're
Yep.
you're at a set amount that
Yep.
you can depend upon and so on. Now we also have some performance indexed ones that do actually in the tens and some cases higher, but those do fluctuate.
Yeah, I was going to say it's got to be riskier. Yeah.
Yeah, well, you're not risky in the sense that if it goes below if the market crashes and it's indexed to the market, you're not going to lose your principal and you're not going to lose your gains. So you just won't make a whole lot for that period of time. So still a good option. So depending on your risk factor, you might want to put some in a fixed. That way you got your steady, and then you got this one over here for growth, right? So as we're kind of winding down, we're going to hit this up a little bit later in a part 2, because we're going to be talking a little bit about these strategies. But we talked about finding something valuable. You want to buy it low and sell it high. So if it's a stock, if it's real estate or whatever, definitely there. If it's an emerging business sector that has a lot of potential, the .com stuff. There was a great time to get in on that on the front end, but what happened on the back end? They called it the .com bubble burst, right? So people didn't understand it well enough to know which investment would be good, which investment would be bad. If you invested in, Amazon or Facebook, you're killing it now. But if you invested in some of these other things that looked good on paper, but you don't understand it, they lost all their money. So we had a crash back then. So the more information you have about that business sector, the better. Then you can take calculated risks on it. Now, the best way to make money, to be honest, is hard work. Now, unless you're the guy in Oregon that just got $1.2 billion from the lottery, people might say, well, hey, luck's the best way. Well, my definition of luck is when opportunity meets preparation. And I don't know about you, but the harder I work, the luckier I get. So the key is to take your money and invest it over time. I'm going to leave you with this thought as we're going out of the program today. You will invest money in beer on the weekends, going out to dinner. You'll invest money and you'll pay expensive cars, you'll pay mortgages. How many of you are investing in your future? You'll pay $100 a month here, $1,000 a month there, 200, 300, paying everyone else to make them money. What are you investing in yourself and in your future? Compounding interest, people, over time will make you a pretty good chunk of money. And people don't invest in themselves. They don't invest in their future. Time is not going to be there for you. It's going to go away every year. Look at where you were 10 years ago. Blink your eyes.
Isn't America one of the lowest investing nations
It
in the
is.
world?
It is, ironically. Yeah. I mean, I've heard that in the developed world, technically.
Yes, yeah, that's what I meant, yeah.
To your point, yes, it goes back to my comment that they're not teaching this stuff in school. If you are 18 or 19 years old and you've got your first job, what if you just put $50 a month, $100 a month towards your future? I mean, by the time you get to be 45 years old, 50 years old, I mean, it's amazing how much you would have. Last thought here. Here's one example: an investment of $100 in the S&P 500 back in 1970, just $100. This isn't adding to it. This is just putting $100 in 1970. Would now be worth $7,771.
Nice. Yeah.
Now, what if you took $100 a month since 1970? Now you're looking at $1 million plus, right? You get what I'm saying? So time is your best friend when you're investing. It's your worst enemy when you are not. So I want you to think about that. Reach out to us over here at sunpalmfinancial.com. Get on our schedule. We can show you how to invest in small dollar amounts and build a nest egg for your future. Or if you already got a large sum and you want to put it somewhere safe, that it's going to be there for the rest of your life and you can enjoy your life, come talk to us. sunpalmfinancial.com, 561-783-3334. And reach out to us. We'd love to talk to you.
All right. That sounds great. Now, again, the website again?
sunpalmfinancial.com. And you can go to meet with us or schedule an appointment with us and get on our calendar. Just pick an available date. Or you can call us at 561-783-3334. We prefer that you get on our calendar because we're out and about all the time. But sunpalmfinancial.com.
All right. Hey, have a good week. We'll see you next week.
Likewise.